If you look at the headlines today, it feels like the world is drowning in red ink. The United States is tens of trillions of dollars in debt. China carries staggering obligations. Europe is buried under decades of borrowing, and Japan's debt exceeds twice the size of its entire economy. And yet, life goes on. Governments continue to spend, markets keep trading, and people continue to save, invest, and retire. It raises a question that almost nobody can answer clearly. If every country is in debt, who is the money actually owed to? At first glance, it sounds like there should be a villain, a shadowy lender, or a powerful group pulling the strings. But the deeper you look, the stranger the answer becomes. Global debt doesn't move in straight lines, it moves in circles. Once you understand how those circles work, it becomes clear that modern civilization isn't built on stability, but on motion. Constant borrowing, lending, rolling over, and reinvesting. Debt is no longer just a financial tool. It has become the lifeblood of our global economic system, affecting governments, businesses, and individuals alike. This isn't just a story about money. It's a story about how the modern world functions and what might happen if that lending ever stops. Before we dive deeper, if you enjoyed deep dive documentaries like this, make sure to like the video, subscribe, and leave a comment. Your support helps keep content like this coming. Debt, at its core, is simple. Thousands of years ago, before money as we know it existed, debt was personal. If your neighbor lent you grain in the spring, you repaid them after harvest, perhaps with a little extra as thanks. There were no interest rates, no contracts, just trust. Debt has always been about borrowing from tomorrow to solve a problem today. As societies grew, those promises had to scale. Kings needed armies, empires required roads, ships, and fortresses, and no single person was rich enough to fund these ambitions alone. Governments did something revolutionary. They sold debt. In the 1600s, England faced a problem that would change history. The crown needed money for war, but nobles refused to lend further. So the government turned to the public, allowing ordinary citizens to lend money in exchange for a written promise of repayment plus interest. These bonds quietly transformed the world, giving governments enormous sums without immediate taxation and offering investors a relatively safe way to earn returns. Over time, the system spread globally, and by the 20th century, debt had gone international. World wars pushed borrowing to unprecedented levels, not just to fight, but to rebuild entire continents. Governments realized that debt could not only fund wars, but also stimulate innovation, infrastructure, and economic growth in ways taxation alone never could. Then, in 1944, world leaders redesigned the global financial system at Bretton Woods. The US dollar became the center of global trade. Other currencies were pegged to the dollar, and the dollar itself was tied to gold. It worked initially, but gold is limited, and economic growth is not. By 1971, the system broke when President Richard Nixon ended the dollar's link to gold, ushering in fiat currency, money valuable because governments declared it so, not because it was backed by a physical commodity. This single decision changed everything. Governments could now create money more freely, borrow more easily, and fuel economic growth without immediate physical constraints. From the 1980s onward, global debt exploded, and borrowing stopped being a last resort, becoming a standard tool of economic policy. Governments borrowed to build infrastructure, fund healthcare, stabilize economies during recessions, and prevent financial collapse. Debt became the engine of growth, powering everything from education to technological innovation, and even influencing geopolitics as nations leveraged financial instruments to exert influence globally. Today, global debt, public and private combined, exceeds $300 trillion, more than 3 times the value of everything the world produces in a year. To grasp the scale, consider this. A stack of $1 million bills would reach 100 meters, roughly a 30-story building. $1 billion would stretch 100 kilometers into the sky. $300 trillion? It would reach the moon and back dozens of times. So again, If everyone is borrowing, who is lending? Understanding modern debt requires looking at how it actually functions. Take the United States. Despite being the most indebted country, about 70% of its government debt is owed to Americans themselves. It seems impossible at first. How can a country owe money to itself? But it works through treasury bonds. When the U.S. government needs money, it issues these bonds, investors buy them, the government spends the funds and later pays bondholders with interest. These mechanisms are deeply integrated into daily life. Your retirement fund, bank savings, and even insurance policies are tied to government debt. These bonds are purchased by banks, pension funds, insurance companies, investment firms, and even ordinary people, often without them realizing it. Deposits in banks don't sit idle. Banks lend, invest, and one of the safest investments is government debt. This creates a hidden loop. Savings become loans, loans become government spending becomes income for workers and businesses, and that income eventually returns as new savings, which are lent out again. On the international scale, roughly 30% of U.S. debt is held overseas. Foreign governments, central banks, and investors buy U.S. bonds because they are liquid, stable, and trusted. China, Japan, and European institutions participate heavily, while American investors also purchase foreign debt. Money flows in, out, and back again, circulating like a vast network of financial rivers. Debt is rarely paid off in the traditional sense. Instead, governments roll it over, issuing new bonds to pay off old ones, creating a rhythm that maintains the world economy's pulse. The real risk in debt isn't the amount owed, but confidence. When investors trust a government's stability, lending continues. When that trust evaporates, the consequences can be devastating. Greece in 2008, Sri Lanka, and Pakistan illustrate this vividly. When borrowing costs exceed economic growth, debt transforms from a tool to a trap, forcing governments into painful decisions, cutting spending, raising taxes, or printing money. Printing money, while tempting, reduces currency value and triggers inflation, quietly redistributing wealth from savers to borrowers. Venezuela in the late 2000s serves as a dramatic extreme, where hyperinflation wiped out savings and rendered the currency nearly worthless. Most nations will not experience this extreme, but even moderate inflation reshapes society and investor behavior, which is why central banks buy gold and other real assets as a hedge. Debt, in essence, has become a subtle form of governance. It incentivizes trust, patience, and planning while punishing mismanagement and impulsive financial decisions. Debt, it turns out, is not a flaw. It is the system itself. Modern economies rely on borrowing to grow, with the assumption that confidence and momentum will persist. If governments suddenly stopped borrowing, economic activity would collapse. Businesses would earn less, workers would lose jobs, and tax revenue would fall. The feedback loop that drives growth would reverse. This is why austerity is politically toxic and why debt continues growing decade after decade. So if every country is in debt, who is owed money? Simply put, it is owed to savers, pension funds, banks, insurance companies, governments, and ultimately people themselves. We are both the lenders and the borrowers. Debt circulates inside the system, not outside it. The real danger lies not in the amount of debt, but in the fragility of trust. If confidence breaks, the motion that sustains the global economy stops. Repayment becomes less relevant than the perception that borrowing can continue. Modern civilization is built on this constant motion. Understanding that changes the perspective on debt. It is neither inherently dangerous nor inherently safe. It is a complex engine, balancing trust, motion, and growth. The question we face today is not when the debt will be repaid. It won't be. But whether the cycle can continue and at what cost. Is global debt a manageable engine of growth, or is it a fragile system built entirely on faith and momentum? The answer will define the economic realities of our world for generations to come, shaping everything from the value of your savings to the stability of nations and the future of international relations.